Stop what you're doing just a second and think about this. How much did you pay in taxes last year? Whatever that number is, I'm willing to bet it was at least 30% more than it needed to be. Right now, as you're watching this, you could be leaving thousands of dollars on the table every single year. I'm about to share something with you that's going to make you either really excited or really angry, maybe both. I was talking to a client last week, Sarah, and she said something that made my blood boil. She told me her previous CPA said, "You should be grateful you're paying so much in taxes. It means your business is successful." Are you kidding? That's like saying you should be grateful your house is on fire because it means you have a house. It's absolutely nonsense, and frankly, it's exactly the kind of dismissive attitude that keeps business owners overpaying year after year. Here's what Sarah's CPA didn't tell her. There are 5 specific tax strategies available to LLC owners that could have saved her over $15,000 last year alone. 5 strategies that are completely legal, completely ethical, and completely ignored by most traditional CPAs. By the end of this video, you're going to know exactly what those 5 strategies are, how to implement them, and why your current CPA probably hasn't mentioned a single one of them. Let's start with the first strategy that could put money back in. Let's start with the first strategy that could put money back in your pocket immediately. And it's one that almost every new LLC owner completely misses. It's called startup and organizational cost. And here's why this is so powerful. You can deduct up to $5,000 in your very first year for expenses you incurred before your business was even operational. Think about that for a second. Before you made your first dollar, you probably spent money on market research, competitor analysis, website creation, training, maybe even travel to scout locations. Most people think, well, the business wasn't making money yet, so I can't write those off. Wrong. The IRS specifically allows you to deduct these costs because they understand that businesses need to invest before they can operate. And here's the kicker. If you spent more than $5,000 getting your business started, you don't lose those deductions. They get amortized over 180 months, which means you're still getting tax benefits for 15 years. I had a client who came to me 3 years after starting his business. He'd spent $12,000 on training, website development, and market research before he even opened his doors. His previous CPA never mentioned this deduction. Not once. We went back and amended his returns and got a refund check for over $4,000 that was rightfully his, sitting in the government's account, earning them interest instead of him. But here's what really gets me fired up about this. This isn't some obscure loophole. This is basic tax law. It's right there in the tax code, clear as day. But his CPA either didn't know about it or was too lazy to look for it. Here's what you absolutely must do. Keep detailed records. I'm talking about receipts, bank statements, credit card statements, everything. Because if you can't prove you spent the money, you can't deduct it. And here's a pro tip that could save you even more money. If you're thinking about starting an LLC but haven't done it yet, start tracking your expenses now. Every dollar you spend researching your business, every course you take, every consultation you pay for, all of that can potentially be deducted as startup cost once you officially form your LLC. Now let's talk about the second strategy, and this one is probably the most misunderstood deduction in the entire tax code. The home office deduction. I cannot tell you how many times I've heard CPAs say, "Oh, don't take the home office deduction, it's a red flag. You'll get audited." That's complete garbage. The home office deduction isn't a red flag. It's a legitimate business expense that millions of business owners are entitled to take. And if your CPA is telling you not to take it, they're either uninformed or they're scared of doing their job properly. Here's the truth. I've been doing this for over 20 years, and I have never, not once, seen someone audited specifically because they took a home office deduction. Not once. But let me tell you what I have seen. Business owners leaving thousands of dollars on the table every year because their CPA was too scared to claim a deduction they were legally entitled to. So let's break this down. If you have a space in your home that you use regularly and exclusively for business, you can deduct a portion of your home expenses. And I'm not just talking about rent or mortgage interest. I'm talking about utilities, insurance, repairs, maintenance, even a portion of your property taxes if you own your home. Now, there are two ways to calculate this deduction, and most people choose the wrong. The first way is the simplified method. You can deduct $5 per square foot of your home office up to 300 square feet. That gives you a maximum deduction of $1,500. But here's where most people stop, and it's costing them money. The second way is the actual expense method, and this is almost always going to give you a bigger deduction. Here's how it works. You calculate what percentage of your home your office represents. Then you deduct that percentage of your qualifying home expenses. Let me give you a real example. I had a client with a 1,500 square foot home and 200 square foot home office. That's about 13% of her home. Her total qualifying home expenses were $22,000 per year. Mortgage interest, property taxes, utilities, insurance, repairs, the works. 13% of $22,000 is about $2,900. That's almost double what she would have gotten with the simplified method. The word is exclusively. The space has to be used exclusively for business. You can't claim your kitchen table as a home office if your kids do homework there. But if you have a spare bedroom that you've converted into an office, or even just a corner of a room that's clearly designated as your workspace, you're good to go. Let's move on to the third strategy, and this one is huge for most business owners: vehicle expenses. If you use your vehicle for business, and I mean any business use at all, you're entitled to deduct those expenses. But here's where most people mess this up. They either don't track their miles at all, or they choose the wrong deduction method. There are two ways to deduct vehicle expenses, and the difference between choosing the right method and the wrong method could literally be thousands of dollars per year. The first method is the standard mileage rate. In 2025, the standard mileage rate is 70 cents. So if you drive 10,000 business miles, you get a $7,000 deduction. Pretty straightforward. But here's what most people don't realize. The actual expense method can often give you a much bigger deduction, especially if you have an expensive vehicle or if you drive a lot of business miles. With the actual expense method, you deduct the actual cost of operating your vehicle: gas, insurance, maintenance, repairs, registration fees, and depreciation, multiplied by the percentage of business use. Let me give you a real example that'll blow your mind. I had a client who bought a $50,000 truck for his construction business. He was using the standard mileage method and getting about $8,000 per year in deductions. We switched him to the actual expense method and used Section 179 depreciation, which allows you to deduct the entire cost of qualifying vehicles in the first year. And his deduction jumped to over $40,000 in year one. $40,000 versus $8,000. Same truck, same business use, just a different method of calculating the deduction. Now, here's the key. Vehicles that weigh over 6,000 pounds qualify for this accelerated depreciation. We're talking about most pickup trucks, large SUVs, and commercial vehicles. If you bought one of these vehicles for business use, you could potentially deduct the entire purchase price in the first year. But even if you have a regular car, the actual expense method can save you money. Here's why. When you use the standard mileage rate, you're essentially letting the IRS decide what your vehicle costs are. But what if your actual costs are higher than what the IRS assumes? Here's my recommendation. Use an app like Mile IQ or QuickBooks to track your mileage automatically. Set it up once and it'll track every trip you take. Then at the end of the year, you can categorize your trips as business or personal and have a completed record of your business mileage. But here's something most CPAs won't tell you. You can also deduct mileage for trips that aren't directly to client meetings. Trips to the bank for business trips, to the office supply store, trips to meet with your attorney or accountant, all of that counts as business mileage. Now let's talk about the fourth strategy, and this one is beautiful because it gives you immediate tax relief: marketing and advertising expenses. Here's what makes this deduction so powerful. Unlike some business expenses that have to be depreciated over several years, marketing and advertising costs are 100% deductible in the year you spend the money. Think about that. You spend $5,000 on Facebook ads in January, you get to deduct $5,000 on your taxes, that's in year. You invest $10,000 in a new website, that's a $10,000 deduction. You pay for SEO services, Google ads, business cards, flyers, trade show booths. All of it is immediately deductible. But here's where most business owners are missing out. They're thinking too narrowly about what counts as marketing and advertising. Yes, obvious things like paid advertising count, but so do a lot of expenses that you might not be thinking of as marketing. Business networking events, industry conferences, even meals with potential clients or referral partners. All of these can qualify as marketing expenses. I had a client in the real estate business who was spending about $15,000 per year on various marketing activities. But she was only deducting about half of that because she didn't realize how broad the marketing category could be. We expanded her tracking to include networking event fees, meals with potential clients, promotional items she gave away at open houses, even the cost of maintaining her professional social media presence. Her marketing deductions nearly doubled. Now, let me tell you about a strategy that most people completely miss: content creation expenses. If you're creating content to market your business, blog posts, videos, social media content, the expenses associated with that content creation are deductible. We're talking about equipment, software, hosting fees, even the cost of hiring freelancers to help with content creation. I have clients who are deducting thousands of dollars per year in content creation expenses. Camera equipment, editing software, graphic design services, all of it adds up to significant tax savings. And here's a pro tip that can save you hundreds or even thousands. If you attend conferences or events for business purposes, not only are the registration fees deductible, but so are your travel expenses, meals, and lodging. These events are essentially marketing opportunities where you're building relationships and learning about your industry. Now we get to the fifth and most powerful strategy. And this one could literally save you 15.3% on a huge chunk of your income. It's called the S-Corporation election, and it's the secret weapon that separates small business owners from everyone else. Here's the deal. When you own an LLC, by default, you're paying self-employment tax on all of your business profits. That's 15.3% on top of your regular income taxes. So if your LLC makes $100,000 in profit, you're paying over $15,000 just in self-employment taxes. But here's what most CPAs won't tell you. You can elect to have your LLC taxed as an S-Corp, and when you do, you only pay self-employment taxes on the salary you pay yourself, not on the entire profit of the business. Let me break this down with a real example because this is where the magic happens. Let's say your LLC makes $150,000 in profit. As a regular LLC, you're paying self-employment tax on the entire $150,000. That's about $23,000 in self-employment taxes alone. But if you elect S-Corporation status, you might pay yourself a reasonable salary of, let's say, $70,000. You pay self-employment tax on that $70,000, about $10,700. The remaining $80,000 comes to you as a distribution, and distributions aren't subject to self-employment tax. You just saved over $12,000 that stays in your pocket instead of going to the government. Now, I know what you're thinking. This sounds too good to be true. What's the catch? The catch is that you have to pay yourself a reasonable salary. The IRS isn't stupid. They know what this election does, and they've built in safeguards. You can't pay yourself $20,000 and take $130,000 in distributions. That's not reasonable. And the IRS will come after you. But here's the thing. Reasonable doesn't mean maximum. It means what someone in your position, in your industry, in your geographic area would typically earn. And there's usually a pretty wide range of what's considered reasonable. I had a client who was making about $200,000 per year in her consulting business. We elected S-Corporation status and set her salary at $90,000, which was reasonable for someone with her experience in her market. She saved over $16,000 per year in self-employment taxes. But here's where most CPAs mess this up. They're so scared of the IRS that they set the salary too high. They tell you to pay yourself 80% of the profit as salary, which defeats the whole purpose of the election. Now, there are some additional costs with S-Corporation status. You have to run payroll, which means payroll taxes and potentially payroll processing fees. You have to file a separate business tax return. But even with these additional costs, the tax savings usually far outweigh the expenses. And here's something most people don't realize. The S corporation election isn't just about self-employment tax savings. It also opens up additional tax planning opportunities. You can contribute more to retirement accounts, you can deduct health insurance premiums, and you have more flexibility in how you structure your compensation. But timing is crucial. You generally have to make this election by March 15th of the year you want it to take effect. Miss that deadline and you're stuck waiting until the following year. However, there's a little known provision that allows you to make a late election in certain circumstances. I've helped clients save tens of thousands of dollars by making late S corporation elections, but it requires specific procedures and documentation. So there you have it. 5 strategies that could save you thousands of dollars in taxes this year alone. Startup costs that most people never claim. Home office deductions that scared CPAs won't touch. Vehicle expenses that could put serious money back in your pocket. Marketing deductions that give you immediate tax relief. And the S corporation election that could save you 15.3% on a huge chunk of your income. But here's what I want you to understand. These aren't loopholes. These aren't gray areas. These are legitimate tax strategies that are written right into the tax code. The government wants you to use these strategies because they incentivize the behaviors that grow our economy. Starting businesses, creating jobs, investing in equipment, marketing your services. The problem is that most CPAs are either too scared or too uninformed to help you take advantage of these opportunities. They'd rather play it safe and let you overpay than do the work required to maximize your tax savings. If you found this video helpful, make sure to hit that like button. It really helps the YouTube algorithm. If you found this video helpful, make sure to hit that like button. It really helps the YouTube algorithm show this content to other business owners who need to see it. And that's exactly why I wrote my book, Your Biggest Expense: How to Legally Pay Less in Taxes and Keep More Wealth. Because I'm tired of watching smart business owners get ripped off by a system that's supposed to be working in their favor. In this book, I reveal 10 powerful tax strategies that go way beyond what we covered today. I show you exactly how to implement each strategy, how to document everything properly, and how to auto-proof your tax savings. Most importantly, I show you how to think like a tax strategist instead of just a business owner who pays whatever their CPA tells them to pay. Go to yourbiggestexpense.com right now and grab your copy of the book. The link is in the description below. It's the investment that will pay for itself many times over, and it might just be the difference between building real wealth and just getting by. The strategies I shared today could easily save you $5,000, $10,000, or even $20,000 or more this year. So if you found this video helpful, like button and subscribe for more tax strategies that actually work, and drop a comment below. Were you aware of these tax saving strategies? Has your CPA ever said you shouldn't take the business use of the home deduction for fear of an audit? I read every comment and often turn them into future video topics. Make sure you're subscribed because I'm always sharing strategies like this that can save you thousands in taxes, and you don't want to miss out on what's coming next. Thanks for watching, and remember, keep more of what you earn.